Well, thanks everybody for joining. I'm Cohen Rose from Stoic Point Capital Management, and we are investors in what we believe is a great business with a great management team called Janus International. And today we're hosting the CEO, Ramey Jackson, and CFO, Anselm Wong, to talk about Janus, talk about the business, the opportunity set, self-storage, and the company's capital allocation, and a whole range of topics. So we appreciate everybody joining. And special thanks to Ramey and Anselm for hopping on to do this. Hopefully we get to reach a potential new set of investors doing an event like this. So maybe it's helpful to start just talking about AI and ChatGPT and how that might impact the self-storage business, because you can't have a conversation these days without one of those topics. But fortunately, do not have to talk about that today.
Right.
Finally.
Fantastic.
Yeah, I would love, you guys
have the first curveball.
Yeah, that's right. You've not been public that long. It's been about 2 years, I think, since the go public. And I think what's sometimes lost in the history of some of these companies and news public is just the history of the company. And maybe just take us back to the founding of this business, how long it's been around. You were there since the beginning, and maybe just walk us quickly through, what happened, changes in ownership, acquisitions along the way that were material, and kind of the building of Janus until the go public a couple of years ago.
Yeah, of course. So there's a lot there. I'll try to just highlight what I believe are the high points. But so this is our 21st year in business. We started out as what I believe a lot of a kind of misconception about what Janus is, but we started out as a door company. Self-storage was very different back in 2002. Basically, it was the owner operators were kind of independent operators that did not require installation and kind of the value-added services that we offer today. So we were a manufacturer of doors. Started in Temple, Georgia, kind of moved to the west. Our first expansion was in Phoenix. Then we went kind of back to the central part of the country to Houston, Texas. Around 2005, we had a lot of customers going to the European market, kind of seeking the early phases of development. And so we did a joint venture partnership in the UK. So that was our next move, and really started noticing a big trend on the commercial side of the business, or a big pull forward in terms of our type of product in the commercial sector of the space. So we kind of ramped up our manufacturing capabilities to kind of get into that commercial sector from a diversification play. And it was super easy for us. I mean, a lot of the stuff that we manufacture for self-storage is the same equipment that you would have to satisfy the commercial product. And so we ramped up sales and marketing and had a nice, what we thought was a diversified business that, kind of catered to self-storage doors and also the commercial industrial market. Around 2010-ish, we started seeing the self-storage industry kind of change as real estate became more expensive. You started seeing the type of self-storage go from big kind of warehouses to multi-level type construction that's prevalent today. And that was a great industry shift for us because it allowed us to have more content within those facilities. So we started doing a lot of the hallways, the partitioning, basically everything on the inside of a self-storage facility. Grew really fast. The main founder of this business, was convinced that, with the help of some private equity, take some chips off the table, that we could really expand the business. So in 2013, we brought on a equity sponsor, which was Sawmill Capital. And it was a great relationship. They were good stewards of the business. We pretty much outgrew them really fast within a year or two. 2018, we decided to sell to Clear Lake Capital. Again, phenomenal stewards of the business. They let us run and operate the business as we always have, and they're still, shareholders, which I guess we'll broach that topic later on in the conversation. And so, yeah, I mean, it's the business went from a products business to a service and solution platform, which is what we are today, and we'll kind of get into the nuts and bolts of that and things of that nature. But that's just a high level overview of Janus.
Yeah, and I think to add to the story, obviously, when Janus was sold to Clear Lake, obviously one of the big next things that I know Ramey had decided to say, hey, bring this company public. And obviously it was actually done through a de-SPAC to be public. And the SPAC that, Ramey chose was after reviewing multiple ones, was one that was led by, former Honeywell executives, former Vice Chairman Roger Fraden, the former CFO Tom Slozak, former M&A leader Brian Cook. So really brought in that, industrial technology as well as public company knowledge to the company that really helped further the growth and expansion that Ramey and the balance of the founders had done. And as of this point, like you said, clearly still a shareholder, but everything that you would expect, warrants and everything is gone from the de-SPAC. So really the only last thing left from the de-SPAC days is really just the large ownership of Clear Lake. Clear Lake actually announced an ATM in the quarter past, and they sold a meaningful amount of shares. So they at least signal that they are exiting their investment. And again, I agree with you, Ramey. Even my short time here, about a year, they've really been strong, and really good supporters of the business and really support a lot of things that we've done for growth.
Great. And maybe remind me, new investors, since being public, you've done one acquisition, correct? DBCI. And, I guess if we think about your life as a public company so far, how's it going? I think the DBC was out of the gates, but anything different about being public these days versus life as a private company?
Yeah, there's a lot different. I'll kind of start out with the DBCI. We've actually acquired two businesses, Colin. DBCI was our largest competitor in North America. And then we also acquired a company called ACT, which is a low voltage kind of professional installation company that really bolstered our smart entry, Noki smart entry systems. So we've had two acquisitions, both very successful. And in terms of is life different? Absolutely. We spend a lot of time doing things of this nature and talking about the company. And so we're super excited to do that. But yeah, I think if you look at the team from when we went public today, you'll see a big Honeywell influence of professionals. Anselm would be one of them. He was previously at Honeywell with the Residio spin, things of that nature. John as well was kind of an FP&A guy at Honeywell, and we have a few others. Our Noki leader today was over a big segment of Honeywell. So you're seeing more professionalism that we're bringing in, as part of being public. FP&A matters today, where it wasn't as important as in the private setting, but yeah, we're professionalizing the business more. But at the end of the day, it's really the same industry and a lot of the same people that have been here for 20 years. Just at the corporate level, we're certainly making some changes.
Great. Well, great intro. We get into this business itself and self-storage. I think part of your, speaking of investor events, your job as a public company has probably been educating investors in this space who aren't REIT investors about the self-storage industry. There are few, if any, other public companies that aren't REITs that focus on this industry, certainly with this much exposure to it. So I imagine a lot of your time is spent explaining the drivers of this. This is not new home construction or commercial construction, which investors, certainly buildings products investors, industrial investors, are well steeped in at this point. But maybe before we go to the industry, I want to talk about the company in particular. And, I think one thing that stands out probably very clearly to investors once they do, a day of work is the margins and returns on capital at Janus are among the highest in buildings products. The margins are among the highest. I think the tangible return on capital might be the highest of any, decent sized buildings products company around. Benefited from some acquisitions, obviously, but I wanted to just unpack the drivers of that and talk about, I think when investors think about buildings products companies, they think of lower margins, tougher businesses, commodity exposure. And you've put together this business that, at least historically, has generated some top quartile results. And maybe if there are a few things you can highlight for investors as to how do you explain these high margins, this high capital efficiency? Why do you think this is different than some of the other buildings products businesses we might be familiar with, whether that's door companies in other markets or companies that make steel or commodity-based products that go into buildings?
Yeah, great question. I'll kind of start out by kind of referencing what I mentioned a minute ago. We're not a products business. We are a solutions provider. And what that means is, our go-to-market strategy is very unique. When you look at the building product sector, you're typically bound by a bidding process where architects are having to specify your products, and then it's bid out to a host of general contractors that are looking for the lowest price. That's not our model. We have great relationships with, well, let me back up. We view the self-storage as kind of in two buckets: the institutional market and non-institutional. The institutional market would be all of the REITs that you spoke about, and then obviously other institutional investors that are kind of ROI focused, return focused. That's really our sweet spot, because we hit the easy button, right? They come to us with a concept, whether it's a plot of land, and we basically do all of the work from looking at the design of the actual facility, breaking down the interior unit mix, which is arguably the most important part of the self-storage, is getting the interior unit mix right. We have just a tremendous amount of data and history to, location specific in terms of what is the most efficient layout for storage. That is very desirable with the institutional folks. We do all,
and that applies not just to smaller. I could see a 1-man, 2-man, or 2 or 3 property developer really leaning on that. But does that apply? You obviously have some very big asset owners in this industry, the public REITs and the institutional guys. Are they similar users of services like this?
Very much so. In fact, what I would say is it's more important to the institutional operator than it is the non-institutional, because you really have to get that mix right. And so a lot of times they will send over their proposed mix, and we'll kind of go back and forth with, it has to fit in, obviously, number one, the building design. And then what we'll do is go back and look at the data in the surrounding area in terms of what's in the market, and then make proposals based off of kind of current trends and things of that nature. So when I speak of these kind of all of these value-added services that we do on the front end for free, that's really where the institutional owner operator, that's where, we make it very easy to do business with. We do all this free stuff up front. And so, and you really can't go anywhere else to get this. You're not going to get this from a specific architect or a specific general contractor. So we're way ahead of that. We help them build out these teams. And then obviously from there, we do the installation, kind of the turnkey solution. And so that's really the difference. And that is very uncommon in terms of when you think about building products. We are not a general bidder, to the open market. We are customer specific, project specific on the design and pricing of that project. I mentioned the installation. Yeah, that sounds very normal, but it's super mission critical. We are the last trade on a project. So you can imagine, especially with all the supply chain issues we recently had, all of the compounding issues really become our issues. So we really have to get that right. And the operator, they just want to open up the facility to start generating revenue. So we've built a comprehensive project management field team throughout the country that obviously is very important in that mission critical success. To get it right, owners really care about that, and you can only mess up a few times in the field before it becomes problematic and for future work. So we understand that, and have, like I said, build out infrastructure for that type of success. So we're doing a lot of things that other manufacturers, so to speak, that maybe our comps or even our competitors do not do, and it's just part of our go-to-market strategy, Colin. And I think when you look at where we land, we're a small percentage of the overall cost of this stuff. It's circa 10% of the overall construction price, or construction cost. So we're kind of, below the radar, so to speak, in terms of big ticket items and in terms of savings.
Yeah. I think one thing that learning for me is probably helpful for people to better understand it is around R3, which is a 30-year business now, that renovations and remodels business, or I forget the other R. So you guys have lots of D's for driver self-storage and lots of R's for.
Yeah, it's restore, rebuild, replace. That's the marketing name for the R&R segment.
Yeah. So that business, it's obviously a big chunk of revenues. I think the other issue I think people have with, I don't know, cyclical businesses is in what investors pay a premium for often is the sense that there are recurring revenues or non-cycle driven revenues, new construction revenues associated with this business. So maybe take a second, talk about R3, because I think it's important to understand maybe why that might be ultimately a higher margin business given the level of service and consultation you're doing with your customers around that business.
Yeah.
And then also we can speak to, and this may take us into just talking about self-storage, but speak to what goes on in that business that isn't necessarily related to the building of a new self-storage facility.
Yeah, so the R3 segment is a bucket that includes kind of door replacements. These products may be at the end of useful life. It could be 88.
What's the life of a door?
25 years. Yeah, 25 years. But that is not a big driver on the R3 revenue, quite frankly, and we'll get into that. So also included in the R3 is what we call expansion, which is very large today. Existing facilities doing additional buildings, kind of add-ons, that falls on the R3 team. Unit mix, interior unit mixes, which I kind of hit on the importance of unit mix. This is a really big driver. The institutional operators have folks that look at the install base and try to maximize the interior economics as markets kind of change. What we're dealing with today is the average kind of unit size. It used to be over 100 square feet, and depending on where it is, a lot of urban markets, it's going down to around 80 square feet. So the units are getting smaller. The savvy operator will pay attention to that, and we have a service that will go in and actually reconfigure the interior. Keep in mind, as we're doing this work, tenants are in these facilities, so we really have to protect ourselves. We have a system that includes a kind of third-party security. We record everything. The owner operator gives the tenant a 30-day notice that we will be doing work inside the facility. They have the option to be there as we're doing the work. It sounds very risky, but it's something that, over the years we've built, and I'll kind of go back to the genesis of it, but it's a meaningful part of the business that will continue to develop with the institutional folks, and it's just additional content per square foot. You'll hear us talk about that a lot. That's really our mantra. It's what we focus on. How can we drive content? So, the unit mix kind of conversion is in the R3 bucket, and then kind of what we call retail conversions. It's been really big the past, call it 4 to 5 years, where a lot of the big box retail, for whatever reason, have abandoned a location. Storage operators are using that space to convert into self-storage. That also falls in the R3 bucket. Like I mentioned, that's accelerated in terms of the velocity and will continue to do so. When you look at our backlog and pipeline, it still remains to be one of the more prevalent ways to bring capacity online. So there's a lot of just kind of aftermarket type, things that we consider R3. You bring Noki into the conversation, which I'm assuming we'll get to that. That's really where the opportunity is. And, that business model, business unit was developed in 2009, back in the recession, and basically, obviously the largest operator at the time, that's changing now, basically came to us. They weren't developing, which they went back and said that was one of their largest mistakes ever, is not deploying capital back in the recession. But they needed to update a lot of their old inventory. So we worked with their legal team and HR team and exclusively worked with them for a couple of years on, the R3 work. And today it's a third of our revenue. And just to kind of, set the tone there, the way that we think about it is 60%. Little over 60% of the install base is over 20 years old. So this whole R3 movement is very early innings from our perspective. So we'll continue to add, things that we do in that R3 space as time goes on.
Yeah, I think if you think about it, there's really no other company that does this. And it's like, there's definitely no national company that does this. And if you think of the other drivers in R3, there's, it's a fragmented market out there, right? Like Ramey had said earlier, it's 30% is REITs, institutions, but at the same time, they're also acquiring other companies. And I think, Ramey built this model to be able to help do that transition. So when you see, acquire a smaller regional guy, or even the bigger one that was announced acquiring, they usually take a look to standardize the facility look. Obviously, the colored doors, they want the same colored doors. So that's what R3 does as well, is that's a big need in the industry, is that as they acquire other smaller operators, they need to standardize those facilities. So there's just a big opportunity there as well every time that happens.
You mentioned something about the self-store, the big box retail conversions, or probably conversions in general, and seeming to be a bigger source of activity than new construction. I was curious if you knew why, or had a theory as to why that is. Is that cheaper for the institutional guys to just use the frame that's there, or maybe it's more convenient and this is driving kind of an increasing convenience of self-storage as opposed to finding a new plot of land to build a new building? I'm curious as kind of why that's been a source of kind of outsized activity. Obviously, I think we're all familiar with like a lot of retail vacancies, but whether that means you actually need to turn it into self-storage or not. Curious why.
I think all the above, Cullen. I think it is cheaper. The actual building cost is clearly cheaper. I think a lot of these former retail locations, they're in great locations. So from a feasibility perspective, you can check that box. I think that considering kind of the post-pandemic permitting issues that operators are having with getting new sites approved, I think that matters. And when you look at where the industry is, there's still a need for a lot of additional square footage to come online. So I think, the ease to market, the cost and timeliness to market matters. And that's where the conversions have really hit a sweet spot. And when you look at what e-commerce is doing to big box retail, I really see a long kind of runway there for conversion. So, and it's a great kind of, I guess, structural change for us, because our dollar content per square foot really doubles and sometimes triples depending on what we're doing. Because we're, when you think about let's call it a Walmart, we'll basically go in and put a mezzanine and turn 100,000 square foot facility and basically double that. And so everything on the inside is Janus material and also installation and services. So that's a great trend for this business. And like I said, I think it's early innings of that. And, I guess it kind of goes back to, it's a great location, the feasibility of it.
Right. It's probably a decent segue to talk about self-storage demand, and back to your role as teachers and educators about self-storage to us public investors who haven't paid much attention to it historically and missed some great investment opportunities along the way, not owning self-storage REITs. But you have obviously been doing this a long time and you've seen a lot. And, sadly, is, once you're a public company, the past is the past. Nobody cares what happened in the past. They don't care about what's going to happen in the future now. And I am curious, maybe for you to spend a couple minutes just talking about not spending I'm sure you spend a lot of time talking about the narrative of self-storage, but today where we sit, how you see this product, what's different about it today and why that might influence what we should expect, thinking about, hey, what's the growth of square footage of this product or demand for this product, or whatever it might be, and setting aside for a moment the cycle, which we are all going to talk about endlessly, but just thinking about the drivers of this product and why there may, or, are we close to full penetration, or is there still a long runway? How do you think about what the institutional investors, owner operators want to do in this industry?
Yeah. So look, there's a lot there. I think that, you really have to understand the drivers to kind of see where the industry is going. A lot of people, and I know we'll hit on that later, you kind of preference that, but they're really life events, right? Life events happen regardless of what's going on in the macro, regardless of, new housing starts, regardless of economic times. My personal opinion is we are public. We are speaking to you today has a lot to do with the way that self-storage behaved back in the GFC. It was the best performing real estate asset class. And I think it's a testament to the resiliency of uncertain times, or even it's counter-cyclical. It's not recession proof, but it certainly appears to be resistant because life events happen regardless. I think the onset of, kind of post-pandemic, where a lot of people moved around the country and continue to do so, and to try to figure out what that balance is it full-time back at work or is it at home? There's some new drivers that came out of the pandemic, and that's decluttering, which is, I would have to say, a lot of people are probably working from home today. Well, you have to make space to do that. The REITs talk about that on their calls often, about some of the new drivers. And then distribution. I think with the onset of e-commerce, think about, fulfillment centers and Amazon, all of these kind of side hustle type businesses that are utilizing self-storage. It is hands down the cheapest form of commercial warehousing that you can find.
What percent of the business or self-storage capacity do you think that is today? Just, I guess, general business or commercial use?
Yeah, I think it depends on who you talk or who you listen to at the REITs, but our data tells us it's 20 to 30%, depending on the market. Yeah, 20 to 30%. And I think kind of post-pandemic, I've heard a lot of different, claims on penetration rate, but it seems to be consistent that it's around 11%. So it's growing.
Yeah.
And so I think there's a tremendous appetite for expansion. I think when you look at the utilization rates alone, the REITs have not reported, but it's probably somewhere in the low 90% in terms of the utilization rates. They will tell you these are their numbers, not ours. We certainly don't dictate, the model, but around 85% is the steady state. That's a great spot to be in terms of churning with pricing and things of that nature. So that alone is exciting to us. And then kind of one topic I wanted to hit on is kind of third-party data. I understand as an investor the frustration you guys have. There's a lack of that there, and it's been a headwind for me personally trying to sell this business, to private equity since 2013. There's just truly a lack of third-party data. That's good data. I think there are a couple of companies that are getting better. But with that being said, we have always used our internal data. Always. We have the best. When you look at our market share, when you look at our history, we have a database of a tremendous amount of data, and that we kind of see where people are moving around on a global basis. So yeah, we trust that data and we make decisions based off that. It's just unfortunate as investors that you can't just believe everything the CEO and the CFO says. You typically have a lot of resources to be able to in terms of check and balance, and it's unfortunate that self-storage, we're not at a place to do that right now. So
yeah, I guess back to the cycle. I think intuitively people think of this is driven by some of these events, moving being a big one. And I think all investors now are looking at existing home sales and thinking about mortgage rates doubled and everyone's locked into their house. And that must be a headwind for this business. How do you respond to that thesis that, well, look, if existing home sales really stay low here because people can't move and can't change out their mortgage at two times the rate, is that a headwind to what you guys do, or are there offsets to that? How do you think?
I think there's offsets. I think that when you look at all of the unique drivers of self-storage, I think there are counters to all of them. The very first thing we heard was, new construction is halting. Your business is going to drop. That certainly was not the case at all.
Yeah, I think maybe it's worth pointing, because I don't think people have this data generally, which is new greenfield construction of self-storage. The peak was 2019, I believe, and it's down quite a bit already since then. So you've absorbed 2020, 2021, and 2022 now, with starts of new developments well below where they were.
And Cullen, we've had record years every year since.
And a lot of growth on top of that.
Yeah.
So,
So yeah, there, again, a lot there. I think that's a great example as to why this business is not built off of new construction self-storage. Right. The platform is robust and diverse enough to where, you know, the mindset in self-storage, if there is a leveling off of new construction, there's still a tremendous amount of inventory that needs to be updated. They have to remain competitive. When you look at the new facilities today, it's hard for an old facility to compete. When you think about the decision maker of self-storage, it's typically a female. You want to make sure that the facility is very secure, well lit, all of those things that are appealing to most people. And so what we've seen over time in different regions, whenever a certain market cools off with new construction, you'll see an uptick in kind of the R&R piece of it. I think Anselm talks about it a lot in terms of how the REITs are, you know, if they don't spend the money and they're going to have to give it back. And so, you know, and I'll kind of, Anselm, I'll kind of open it up to you there on the REIT model, if you'd like.
Yeah, no, definitely. Because I think at the end of the day, they look at what's the right return, which is what you would expect them to do. And as we said, if they have opportunities for R3, whether it be a conversion or an upgrade, they actually take that option because their return on that investment is quicker. If you think about a conversion, they can get into a facility, if it's an old Toys R Us or Best Buy, whatever the retailer that goes out of business, it's very quick for us to get in and out of there to get them up and running so they can return right away. If it's like an upgrade to existing facility, to Ramey's point, they modernize their old inventory. So they could have an old dingy one, not secure, poor lighting, not high tech, older style door, not the ADA compliant one. And once they update that, guess what they do? They actually upgrade the rates as well when they do that, right? So they update their rates, so they're going to make more, and then their occupancy actually goes up because they're more competitive with other guys in the field. So I think that's kind of where that model, where it didn't exist before until Ramey in the business created in 2009 to give them that optionality. Because if you think of before, they didn't have that option to really go in and say, hey, how do you actually update all this stuff when the stuff is sitting there? I think I stress that point because think of how they used to do it. They used to wait till the client exited that one unit, then you go, okay, let me go change the door. That's just not efficient. And the way we've built it out, it's in and out pretty quickly. We do all the planning, everything, so we can get in there because we have the security, we have all the proper process and procedures built out to actually do that effectively and efficiently. So I think that's what you're seeing. And again, it's not my words. If you go back to last quarter to the REITs, two of the big ones basically indicated that they are increasing their R&R spend, for the balance of the year and going into the future because they can see, hey, there's a return there. We're going to actually shift some of the allocation here. So to us, it's great news. It's R3 business for us.
yeah, I think you've had, I mean, you mentioned the anecdote about and maybe the missed opportunity in 2008, 2009, people cutting back tremendously and then regretting not done that. Buying, this asset class in that time period was a phenomenal return opportunity. And I think you've had a pretty significant inflow of other institutional capital into this asset class since that period, and with mandates to make investments in self-storage. So whether that's a new development, maybe they don't want to do development, but they very much want to put some money to work and charge management fees and make profits. And so the opportunity to do renovations in the down market or replacements seems to be, I think you agree, a different, potential tailwind versus certainly the last time we went through a, housing related cycle. Well, I think, look, speaking of that, and it's amazing how much time it's been talking about self-storage. Time just flies by, and no reference to AI yet. But speaking of investment opportunities, we have to talk about Noki. I think it's a very exciting opportunity for the company. And maybe just quickly, so you acquired Noki at the end of 2018, and here we are almost 5 years later, I think, and penetration has been increasing. You're showing some rapid growth, but still off a very small base. And I think maybe it's helpful for new investors, unfamiliar investors, to understand some of the complications of getting this product rolled out and what it's taken and what that means about the potential for the business and the stickiness of this product or the defensibility of this product going forward. Maybe just talk about you bought this business, and then what happened? What have you learned about doing this, rolling out this technology?
Yeah, I'll certainly contribute to this, but I'd probably like for Anselm. I know that Anselm is at Janus for a lot of reasons, but I think the technology piece of it, and Roger Fraden had a lot to do with twisting his arm to have a conversation with me about Janus. But I think the Noki technology certainly excited Anselm more than anything. Anselm, would you like to start out here?
Sure, yeah. Yeah, if you think about it, I think, Janus bought it in 2018, but it did not have the actual device at that time. So obviously there's a lot of learning to actually make a device that actually fit the door, that worked with the door, as well as the thing that everyone forgets about with software and connected technology is the integration with other software that is being used by the other facility and company. So, other major software items like facility management software, billing software is being used by the various self-storage customers already. And unfortunately, there's no standard. So there's multiple versions, including homegrown ones, that anyone that's going to provide a solution like Noki's got to actually integrate with, and as well as consistently update and keep current, because software doesn't stand still, it changes all the time. So this business has gone through a lot of learnings on the software side as well as the physical device hardware side. You got to remember these devices are being used indoors and outdoors, so there's a lot of technical that we have to look at to make sure the wireless works, as well as make sure the item performs in a secure way as well as in a weatherproof way. So there's a lot of learnings that anyone gets into this business has to deal with. I think the exciting thing, like Ramey said, that's the one thing that excited me about this is it is penetration rate is very low right now, but the opportunity is so large. We just printed that we had 204,000 connected devices at the end of Q1. Sounds small, but if you think about the opportunity, there's 25 million doors out there that potentially that can be protected and growing in this industry. So that's a small amount that we've got. And if you think about the use case for the end clients, it's a no-brainer for me, just putting my CFO hat on. You look at it and say, hey, look, in a typical facility, I have 2 to 3 people full time. Well, if I go full Noki on that site, I can actually save the salaries, which could be anywhere $120,000 to $200,000 a year. And for a self-storage operator, their 2 largest costs are property tax and labor. So you can't touch the first one. Unfortunately, that's the government. But the second one you can touch, which is the labor piece. So it almost becomes a no-brainer. And then I think we always get the question, hey, why is the penetration not that quick if that makes sense? And it does make sense. And what we found and just learning, we had always originally thought that the larger REITs or larger companies would take it on. But the issue with the larger companies is that they're dealing with thousands of sites they own. For example, 3,000 sites. You think about introducing change management and saying, hey, look, I'm going to introduce a technology that actually is great for the company. It's going to save the company money, automate things and do things. And if you think in their shoes, it's great. They believe it. We talk to them all the time, all the CEOs, and they agree, and their CFOs, but they also have to balance to say, hey, I also have to run a business. And if I actually all of a sudden say that I'm just doing this, adopting this across the board, I got to deal with all those store managers that I have today running those operations that I can't get to right away. So I can't all of a sudden have a mass exodus of people. So there's a balanced approach that the REITs are doing in terms of testing certain floors, certain operators. And I think what we'll see is a hybrid approach, which is what we've seen with some of them where, hey, let's not do the whole facility, let's do partials and we'll get to the whole facility and we'll teach, the people that remain, because you'll still have people at a hub and spoke type of model where they'll still manage, instead of managing one facility, maybe they'll manage 6 or 7 in a certain area. But what it saves them is now they don't have to do physical lock checks. They don't have to walk the floor. Like imagine a facility is 400 or even 1,000 doors. They physically walk twice a day to check all the locks to make sure, excuse me, that they're closed and locked. So a lot of real productivity benefit from doing the Noki solution that I think it's just really excuse me, no brainer for them.
Gets choked up talking about it.
Yeah, yeah.
Do you have enough data? Look, I heard the Noki pitch in 2020. I was like, this makes a ton of sense, and I know people in the business like this. Yeah. This is great. This is gonna be great. We can save a lot of cost potential, and again, look, it's growing, but I think the penetration is lower than intuitively we might think, given the dominance that you have around selling the door, and the lock should be part of that. Do you have enough data on payback periods or whatever it is to show
definitely. Yeah.
you, CFO?
Oh,
What is
no,
that?
great question, Colin. Yeah. So if you look at some of the smaller operators that have fully adopted, that's what we've seen work well, like, or some of the ones in the US. If you take it again, I'll use top level numbers. A typical site, 400 door site, 3 full-time employees. I'll round the numbers, 200,000 in costs annually they run. A typical site from a cost point of view is roughly $100,000 in hardware to put in. That's the locks, but also the routers, connecting devices, and hubs that you need as well with it. And then the running costs, which I think is too low for us, we're adjusting pricing. Their annual recurring cost that we charge them is roughly today about $1 a month per door. So works out to less than $5,000 a year for right now. So if you think about the cost of them, one time 100,000, 5,000 annual, paybacks less than a year when you do the full solution. And that's who's in Europe, who's done. They are really good customers ours, and really good example, because they started with small. They're about 40, I think 43 locations now. They had 11, acquired like 30 in their last week, and they already mandated all the new ones are going Noki, because they said, look, this is a no-brainer. The payback is like a no-brainer for us. We're just doing it right away because it makes sense. I think there's that big cost element, but the other big element, especially in the US, that people forget is that it's not just the cost. It's actually trying to find the labor. I think it's a hard labor market still. And if you ask any of these self-storage operators, to find the people to actually, stay in the store and be the manager is not as easy as you think it is. So this resolves that issue for them as well, is that now you're not actually having to participate in that labor market, which currently is very hard to find people to do these jobs. So you get the benefit of the cost, but you get the benefit of not having to find the labor. So I think for the smaller operators, it's no brainer. I think the more and more smaller operators that get on this solution, the bigger the push. And it does have another benefit for them. The one thing we talk about is, as interest rates goes up, hey, how do the smaller guys compete? The bigger guys are well capitalized. Well, the smaller guys have to justify their financial models. Like I just said, labor is their biggest cost. So if you can find a way to reduce that piece of their financial model to actually make it work better, it's a no-brainer again for them to say, hey, look, I can afford to pay a bit more interest because my running costs are that much lower per year once you introduce Noki. So I think there's that added benefit, and that's what we're starting to see more from these smarter operators, which I would say leading the charge and putting these. And I think it's just going to build up to a certain amount, besides the intrinsic value of the actual solution, in that, the population is aging, and the younger population, unfortunately, they don't use keys. They used to no key to get in a card, no key to pay Apple Pay. So self-storage is another thing. Is like, why do I need a physical key? Why do I have to worry about bringing that key? So I think there's a lot of drivers that are going to push the Noki solution to be standard. And Ramey, and our goal is, once it becomes standard, obviously you can manage the penetration rate increasing a lot from there.
Yeah. Hey, real quick, Anselm, do you want to hit on the use case on the commercial quickly?
Yeah. The thing that I always just bothers me as I joined this one, and I think it's people aren't taking advantage, especially self-storage, is that they do not charge differently for different different types of customers, especially commercial. You think that if you think about cell phone, you think of internet, when you're a business customer, you pay more, right? There's a reason why. You use it more, you wear out things. Excuse me. In self-storage, they don't have a way to tell a commercial customer, because you sign up, you rent the unit, and that's it. But with excuse me, with Noki, one of the benefits is we have a motion sensor, so you can tell, if someone's in there daily, how many times the door opens and closes, other piece of data. So we can use that to identify if it's a commercial customer or not. And now you have a more concrete way to tell if it's a commercial customer and charge more for those clients. And, if you raise the price a little, they're not going to move. It's minimal cost for them.
Got it. Remind me, the data that's collected, obviously operator sees all that. Is there data that you be able, as the owner of Noki, to be able to utilize for industry purposes or whatever, to, for your own sales and consultation?
Yeah, one of the great things that I saw, actually, I did a lot of diligence as I joined the company, is that we've done the right appropriate legal language in our contract so that we can use the data synonymously. which is kind of the standard for connected software industries. So we're able to leverage that data for other use cases.
Yeah. Is the maybe last question, Noki, it's a weird way to ask, but like the sales thus far, success thus far, is that more on retrofits of existing doors or a new door off the line with an integrated Noki solution?
It's now with the Noki One solution, which is the device that actually just goes on the outside of the door. It's about a 50-50 split. But look, like Anselm mentioned it, there's 25 million doors that are already in the marketplace. That's where we're going to see the outsized growth, is in the retrofit market.
Yeah,
I was curious what the uptake has been. Sounds like kind of even between.
Yeah, and the Noki One, when we came out, it makes it much easier. It just replaces the hasp that's on the door already. So there's no changing there. It's just really unbolt, bolt in, and then add the connected hub devices to actually connect the whole thing.
Got it. I'm cognizant of time. I want to spend just a couple minutes on commercial. It's now a third of the business, and it's very easy to just say self-storage company, but a third of business is now outside of self-storage. And it seems like you've had obviously some successful acquisitions and some serious organic growth in the last few years. So maybe just spend a couple minutes talking about, one, the synergies between these businesses, why it has made sense to put them together, and then two, what you think the opportunity is in commercial over the next several years.
Yeah. So it was, like I mentioned early on, it was a natural fit from a manufacturing process perspective. You have to think early on in this business, we were living and dying from new construction. We were a products business. So the commercial revenue really kind of straightened things out from a production perspective, right? We didn't have the ups and downs for self-storage. We didn't have to worry about the ups and downs of new construction. So it was a nice, benefit of lessening that curve, so to speak. In addition to that, it provides synergies on the cost of our materials. The largest, piece of the product is obviously from steel coil. That's our largest expense in terms of our COGS. We're able to leverage that from a tonnage perspective on procurement. So there's a lot of things.
And manufactured in the same facilities.
Correct. Yeah. So there's a lot of things internally from a manufacturing perspective that make a lot of sense. But quite frankly, the market's very attractive to us. We're a very small percentage of the market today. It's a much larger kind of end market. We're learning a lot about it in terms of, we pulled forward a lot of customers back in the pandemic from a supply chain perspective. We were able to manufacture product, a lot quicker than their primary suppliers. What we did learn is there's, a tremendous amount of R&R. We don't have the touch points with the end market like we do self-storage. So we're having to rely on our distributors and dealers in terms of this market data. But, we're hearing 60 to 70% replacement in terms of the sales of that product. That's exciting to me, regardless of what's going on with Amazon and what they're building or not building. There's a tremendous amount of inventory that needs to be replaced. So
you're saying you think 67% of your sales have gone to just replacement renovation?
I do. Yeah.
Oh, okay.
Yeah, I do. And that's two things. That's number one, listening to customers. Number two, as I mentioned at the beginning, that product for new construction, you really have to be architecturally specified, right? You have to be in the specs, or you're not going to get a shot at it whatsoever. So we're not, we're at the early innings of that architectural journey. We are getting spec'd on new projects, but it's certainly not the lion's share of our revenue. So we're getting a lot of the replacement work, which again is exciting to me. And I also think that as we continue to develop, there's some technology to add. It's kind of like what we did in self-storage. There's some additional content, whether it's technology or safety, things of that nature around the door that are really attractive to us. So yeah, it's a diversification out of self-storage, like that or not. It is what it is. It's very easy for us to manufacture. And when you put the Janus self-storage playbook and apply that to the commercial sector, there's a lot of really exciting things from a inorganic perspective that we like
and
about that.
The difference today is your sales go through kind of an indirect channel to some extent, I believe, as opposed to the way you might sell self-storage. Is that something
That's correct. That's
you
correct.
see
Yeah.
that changing at all over time, or there's a way to get closer to more direct to the customer at some point?
Yeah, I don't think that's a near-term play, quite frankly. I think there's certainly, we have national accounts. We have national accounts with the large freight carriers,
Yeah.
FedEx, all the above. I think that will continue to grow, but really that dealer model is where it is, which is fine with us. We have great relationship, 20+ year relationship with these dealers. As we mature the product line, we're becoming more of a meaningful supplier. So I'm totally fine with that. It's when you think about the upside and kind of the secret sauce on the Janus side with the high margins, or the self-storage side with the high margins, there's a lot around that door, smart technology, safety, things that I mentioned that can really drive margin as well. So I think when you think about Janus and, in the coming years from an M&A perspective, that, it shouldn't surprise anyone that we're looking in that ecosystem, the higher margin stuff around the door from a safety perspective. So it's a great market to be in. And again, we're super early kind of innings in our development.
Great. So, probably a good segue on capital allocation and potential acquisitions. You guys have been acquisitive, and I think people can go back and do some of the numbers. They seem to be successful. DBCI, you paid probably less than 8x EBITDA pro forma for everything, maybe even a lot less than that. And Asta was a nice platform deal in commercial, and it's since grown significantly on an organic basis since doing that deal, and certainly doesn't seem to be dilutive to margins over that period. So we have a business, I think the three of us agree, a great business, good market to be in, self-storage, certainly cyclical, but probably not as certainly cyclical as other commercial or construction related businesses. Noki's an exciting story, commercial is an exciting story. And we have a stock that trades for, 10 times cash earnings, I think, which is not what you would look if you looked on Bloomberg or Cintio Cap IQ today. You might see 13, 14 times earnings, but that includes a healthy dose of non-cash amortization expense from some private equity deals. And so it stands out. And this is the point we've tried to make. It stands out relative to the quality of the business and the opportunity. And you're in a weird place, maybe, with some of the shareholder dynamics and having a large shareholder who wants to exit. But I would ask you point blank, as I have already on your last earnings call, to me, that all sounds like, wow, Janus is a phenomenal investment opportunity. And these guys strike me as good capital allocators. They have made good decisions thus far. And I think leverage is, just using your own numbers, probably at the low end, if not below the low end of your leverage target by the end of the year, just on the growth of EBITDA. So why not take advantage of whatever the misunderstanding is here around this opportunity? And whether that's people still getting up to speed on self-storage, or people getting hung up on some element of this business, maybe just because it's new and you haven't been around long enough or had enough quarters, and really take advantage as a new management team and flex your muscle and buy back some stock. And I'm curious how you think about the trade-offs of that. If there are any trade-offs, why you wouldn't do it, why we aren't doing it. Maybe you don't agree the stock is cheap. I don't know what it is, but I'd love to get your perspective on that topic.
Yeah, look, I can start out. Your point, well received. We hear you loud and clear. I agree with you unequivocally. The stock is super low. Colin, we're looking at, value creation, whether that's through M&A, whether that's, share repurchase. We're looking at all of those things. I know that's not a great answer. What I do have, and I do have full confidence in our board of directors that they will help us make the right decisions. Obviously, M&A has been a big part of our story. It's certainly in my blood to continue to look for, inorganic ways to add value to this business. And so the answer is we are certainly looking at things of that nature. We are in a quiet period, so I can't really elaborate too much there other than we are going to go where the value is. There's no question, and we certainly agree that our share price is certainly on the low end of where it should be. Anselm, do you have anything to add?
No, I agree with you. I think the only additional thing that obviously we're looking at it right now is we're in the middle of refinancing. So we publicly disclosed we did a further pay down of our debt that we disclosed that should close out tomorrow. And then once kind of that timing is done, and I agree with Ramey, we're still reviewing with the board to make that decision.
Yeah. On that point, and maybe just to kind of circle back to what you said publicly, do you will be, I'm going to go on a limb, you will be below or at 2x leverage at the end of this year, which is the low end of your stated range. And, you guys have been a private equity business. You've been levered well beyond that before. You're now public. I think you get all sorts of conflicting or different advice around what's the right capital structure, what's the right capital allocation strategy. I have no doubt you hear it all. Is 2 to 3 times. To me, this strikes me as, look, it's a high margin, low capital intensity business. I think we feel generally comfortable about the cyclicality of this business, how much EBITDA could be off in a down year. Is 2 to 3 times the right range for you? Is there, how do you come to that number?
Yeah, no, we feel it's the right range. I think we've heard, as you know, we've heard many opinions on it. We definitely heard that above 3, especially going into potential recessions, was too high. So we said, hey, look, this business generates really strong cash flow. We can definitely get the lever down, which we have. And you're right. If you look at our guidance, we'll be at the lower range. I think for us, it's that I think that leaves us in a reasonable spot. I don't think, going to investment grade at this point is something we're looking at because of, all the opportunities from an acquisition point of view. I think the key thing, what we've told, all our investors is really, we're going to have a good mindset to make sure we keep that balance in that 2 to 3 times. But if we have to lever up to get something that's, strategic and adds value to the company, we will, but we'll have a good plan to get it back down into that range.
Yeah. Is it, you think there's any chance of refinancing, even not even investment grade, but just given where you were with the metrics you have now of, the lean you have, I think we're up to 8 and change, I think, on a floating basis, to get that down a little bit, given where the metrics are.
We'll see we're in the process right now. So hopefully we will get some, we'll see what it is. Again, I wish I could predict the market right for interest rates, but it's a tough one to call.
Yeah. Okay. Well, it's been an hour, so we have maxed out time here. Is there anything, I don't know if there's anything to add, any closing notes before we sign off?
No, look, I appreciate the opportunity to speak, but would like to do this again. I feel like there's so much more to cover.
There was. We've skipped a couple topics.
Quite frankly, look, I appreciate everyone for their consideration. A lot of exciting stuff here. Obviously, Noki is a free option at this point in time. But Cullen, thank you so much for having us and helping us get our story out, and really appreciate the support, everyone.
Yeah. Thanks for the time, and thanks to SumZero for hosting.
Yeah.
Thank you.
SumZero.